Hey everyone, hope everyone's had a great week and you've got that Friday feeling for the week ahead. Right, a bit of an educational post this one, but one that I think catches lots of people out, newbies, beginner traders in particular. And it's about making sure you focus on the main thing. And the main thing is always going to be profitability and net percentage gain. It's not win rate, it's not pips, okay? And I've got a couple of examples here that really highlight and demonstrate that for you. So first things first, this is the gold trade that we posted on our Instagram story a few days ago. It's running 800 pips in profit, so that's a lot of pips. But more importantly, risking 1%, it's making an 8% running return. And this is what's important to make sure that both are in alignment. If something sounds good, what was the risk initially? Because ultimately, the net percentage gain on your account is going to be as a consequence of a few things. Yes, the running position and where it's going, so what your target is or running amount of pips, yes, but it's mainly derived from where your stop loss is and your risk to reward ratio. Let me try and explain that in a little bit more detail for you. So let's look at three trading examples for three different traders. Firstly, we've got a good example here. We've got Euro USD, a sell position here we're on the 30-minute chart actually here, but we've got a sell open on the 1 hour as well, where 1% risk, running profit is at 3.56% on 81 pips, with the initial risk being 38 pips, okay? But anyway, right, let's imagine there's three traders, trader A, B, and C. They could be trading groups or communities that you follow. Let's say every single one of them three traders claim to make 100 pips on a trade. So they're all celebrating 100 pip trade, 100 pip trade, 100 pip trade. Now, one trader could make 1%, one trader could make 4%, one trader could make 2%. And I bet you're wondering why. Well, it's all based on what their initial stop loss was. Because if you're risking 1% per trade, then if you have a wider stop loss, your entry is smaller. And if you have a tighter stop loss, your lot size can be bigger, which means on the same amount of pips on a winning trade, your profitability can be very, very different. So let me explain that a little bit more. So this trader here, which is trader C, has risked 100 pips in their stop loss to gain 100 pips in their take profit. So they've got a risk to reward ratio of 1, which means that their winning percentage on their winning 100 pips is just 1%, because that's derived from their lot size and their initial percentage risk on that 100 pip stop loss. Let's say we've got trader B. Okay, so this trader had a 25 pip stop loss and a 100 pip target. He had a risk to reward of 1 to 4. So he risked 1%, but he made 4% on the same winning trade amount of 100 pips. And then we've got trader A, which has risked 50 pips to make 100. So he has made 2% on that trade. So ultimately, all three traders can celebrate the fact that they're focusing on a 100 pip trade, when actually one's made 4% and one has made 1%. Now, if you extrapolate that even further, let's say there are 10 trades that happens to in a week. Now, I know I'm using 100 pips as an extreme example, but it's valid and something that you need to consider and go back and look at. So if that was the case, trader 1 claiming 1,000 pips performance for a week is going to have made 20%. Trader 2 also claiming 1,000 pips for the week can be at a 40% account gain. And trader 3, who's also saying that he's made 1,000 pips for the week, might only be at a 10% gain. So it's really important here, guys and girls, to delve into focusing on net profit, risk, stop loss, risk to reward, as opposed to chasing your pips, because we can have the same amount of pips, but a very, very different effect to the profitability on your trading account. It was a short one, 4 minutes 44. Hopefully that added some value to you and your trading. Thanks for watching.